Hello, chart watchers, and welcome to this Thursday, April 4th, 2019 Market Watchers live show with your hosts, Tom Boley and Erin Swinland. For those of you joining us for the first time today, welcome to the show. And for our regulars, welcome back. Let's take a look at what's going on in the market today. We've had a pretty good week. The Dow Jones Industrial Average up 116 points, but a little bit of a bifurcated market, though. The S&P 500 down about a third of a point. The NASDAQ down 23 points, and the Russell 2000 holding on to gains. But you can see the overhead resistance over the past month or so. The Russell 2000 continually trying to negotiate. On a relative basis, too, I think it's pretty obvious that the Russell 2000 is not broken out above the February highs, whereas when we look at the other indices, they all have. So a little bit of underperformance by small caps here over the past few weeks. 10-year Treasury yield still bouncing up there off of that 20-day moving average, unable to get through. I'm watching that along with 2.55% yield resistance. We'll see whether or not we can get through there. Volatility index, we did spike yesterday a bit. It's relatively flat today, still sitting down under 14, though. I would say based on where the volatility sits, it is in the favor of the bulls at this point. Financials and industrials leading today to the upside. And utilities and technology actually trailing. Technology did have a good day yesterday, especially the semiconductors, but we are seeing some profit taking in those areas today. The distillers and vintners having a really strong day. You can see the huge move up. The big reason is Constellation Brands came out with a strong earnings report, beat on the top and bottom lines, and the overall group rising on that. We'll take a look at the Constellation Brands chart in just a bit. Also wanted to mention home construction doing very well today. Definitely we've seen a character change on this chart in 2019. 2018 was mostly downtrending. Really talked about that 20-week moving average. We wanted to get through it. Well, we've gotten through it, and as we've been uptrending, we have continued to hold that on any pullback, and the group trying to break out again. So pretty good action in the home construction group, despite the 10-year Treasury yield rising here over the past week or a little over a week. Okay, Erin, it is Thursday. We're in day 4 of this special anniversary week here at StockCharts. How is your Thursday going?
So far, so good. A little cloudy, though, and chilly. We finally were getting warm weather here in Southern California, and the last 2 days haven't been quite that nice. So hopefully it'll return.
Well, you did say, though, that you enjoyed a nice night out watching the Ducks win.
Yes, always nice to see the Ducks win this season because it hasn't happened as often as it should. So, yeah, it's only one more game left in the season. So we'll enjoy that and look forward to hopefully a better year next year for the Anaheim Ducks.
Yeah, of course, that's hockey that we're referring to, the Anaheim Ducks. But here in South Carolina, we've had so much rain this year that the Ducks are winning here as well.
Exactly.
Put that out there. But anyhow, we have a very, very, very special guest today, Martin Pring. How are you doing today? Martin, I know you're there.
Sorry.
There he is.
Delighted to be with you guys.
Well, we are delighted to have you. It's a very special week. We're going to talk a little bit with you in a little while about how you got started with StockCharts. I think that's going to be an interesting discussion. But did want to welcome you to the show. It's been a while since you've been with us, and I know all of our guests and all of our viewers and all are very excited to hear from you today. So if you can stick around with us for a little bit, we're going to bring you back in about 15 minutes or so, if that's okay.
Okay, look forward to it.
Awesome. All right, Erin, we got another big day, especially from hearing from Martin Pring. So why don't we get things going?
Absolutely. Well, tomorrow we have another tech titan. John Murphy will be, I think we're going to have a video with him that we just sat down with him about Murphy Morris. So that'll be interesting. Tom, you got a workshop coming up on Tuesday. Tony Dwyer will be with us on Wednesday. And then one of our great, professors as far as Wyckoff, Roman Bogomazov, will be here on Thursday. So it's going to be a great week. We still have a lot of great stuff coming to you today and tomorrow, though, too. Today, this is how exciting it is. Today, we do have Martin Pring here. Always good to have him. And we will talk to him a little bit later, as we said. And then our first symbol in the 10 and 10 is going to be Marriott, M-A-R, if you want to go take a look at that chart before Tom does. And then we're going to finish off with a segment called Turning Point. We haven't done this one in a bit of time. At least I haven't been here for it. And so we'll be looking at character changing stocks, something to that effect. Go take the poll too. We'll talk about that. All right, Tom, let's get started. Technical news and headlines.
All right. Yeah, let's take a look at the only economic report that's out. And of course, every Thursday we get the initial jobless claims. They came in much better than expected, 202,000 versus 216,000. And those who are pointing to a possible recession ahead, it really just doesn't align with that at all when we see the initial jobless claims going down. So overall, I thought that was a good report as we take a look at the 10-year Treasury yield. As I mentioned at the top of the show, here is that move up over the past 5 or 6 trading days. We were down at 2.35%. We've gotten back up to 2.51%. Still a far cry from 3.25%, but I think the bond market was sending the Fed a message back in the fourth quarter of 2018. I think the Fed has heard that message, has backed off of the rate hikes that they previously were talking about. And so now it's interesting. Well, it's going to be interesting to see where the Treasury market goes from here. Do we still see a sell-off in the Treasuries with the yield beginning to pick up, indicative of maybe strength somewhere down the road? Or do we roll back over again? If we roll back over, this is an area that it would likely occur or where it could occur from. The 20-day moving average, anytime you're trending up or down, I use the 20-day moving average quite a bit in terms of a guide, if you will. So downtrending yield, we'd be using this 20-day moving average as resistance, yield resistance. And so far, that is where we're struggling. If we do get through, just keep in mind, we had a 2.55% low back in early January. We rose off of that for a couple of months, and then we broke down below. So that yield support becomes yield resistant. So I think the 20-day and 2.55%, something we're going to want to watch pretty closely here. Earnings reports, there were a few out. Of course, the big one, Constellation Brands, that's STZ. They did come out with a really nice report in terms of their both their top and their bottom line. They beat on both. RPM International in the material space, they just matched expectations in terms of revenue, but they did beat on their bottom line. International Speedway, probably the worst of the reports. They missed both top line and bottom line. And then Simple Foods, or Simply Good Foods, I should say, SMPL, did beat top and bottom line, and they actually raised their guidance going forward. So that was an interesting chart that we'll take a look at here in just a moment. But first, I want to start with taking a look at Constellation Brands. So if we pull that one up, you can see here is the move today, up 4.6%. Really nice move. And I think after we got this gap down, a lot of times it's hard to tell when you get these big gap downs. Is it an exhaustion gap or is it not? I think you have to wait. You have to wait to see how the market reacts. Looking back now with that massive volume day, that was the low that we printed, and we have started to rebound off of it. After 2 months of sideways consolidation, we've broken out again to begin April. So I think looking back, that is an exhaustion gap. And right now, until the technicals tell us otherwise, we've got an uptrending stock now with Constellation Brands. And I think their earnings report would help to confirm this move. So again, it was starting to tell us a story before the earnings came out. The earnings have confirmed it. I think we have an uptrending stock here now. RPM, this is RPM International. It is in the specialty commodities area. You can see the big move up. Even though they matched expectations, they did beat on the bottom line, moved a little bit higher. I have a little problem still with any of the materials area simply because I believe we're still in a rising dollar environment. And I believe materials on a relative basis, they have shown that they underperform when the dollar is rising. So until we get more evidence of the dollar falling and declining, I would still tend to steer clear of these material stocks. Maybe look for the best of the best, but otherwise I would tend to stay away. Partly you can see here with the specialty commodities index, we've had a strong 2018, or excuse me, a strong start to 2019, and we are moving to a new year-to-date high. But when you come down here and you look at it relative to the S&P 500, we're still down below where we started the year. So it looks good on an absolute basis, but it doesn't look that great when you're looking at a relative basis. And that is something I focus on. ISCA, International Speedway, they did miss on top and bottom line. You can see the stock has been doing nothing. It's not a very liquid stock either, so it's not one that I would be overly excited about. And when you take a look at it relative to the S&P 500, it's weak. Relative to its peers, it's weak. And the overall group, nothing to write home about. So there's really nothing that piques my interest here as well. Okay, let's go into SMPL because this is the best of the best today, I believe. When you look at the food products have not broken out. September was the high on an absolute basis, but look at what Simply Good Foods has been doing. On a relative basis, you have one of the best stocks in the group. Now, the problem is that the group has not been a great performer. So as I say, if I'm owning a stock that looks really good, but it's in a group that is underperforming, I make no excuses if it starts to fall apart because we know that it's not getting the love at its industry level. So here was a breakout around 21. You've got the rising 20-day moving average coming up from underneath. As long as we remain in an uptrend here, I'm fine with the stock. But if we were to go back and close below that 20-day moving average and see some increasing volume on that move, then I would refer back to the relative chart. And here you can see this is not a good area of the market. So just some things to keep in mind. All right, in my blog this morning, I did write about the commodity chemicals because yesterday we saw specialty chemicals, we saw commodity chemicals have very, very strong days. And I indicated that there was a head and shoulder breakout of a neckline, but there was still overhead resistance that we needed to watch. And perhaps most important, when you look at the commodity chemicals area and compare that or look at it relative to the benchmark S&P 500, this has been downtrending for 18 months. So this is, again, not a good area of the market. And during the same 18-month period, the dollar's been rising for the most part. So as long as the dollar's moving up and we're seeing relative weakness here, I don't trust these pattern breakouts as much. So I would just simply say this. If we don't hold that neckline resistance on a pullback, then I would be very concerned about this move to the upside. Now, we are continuing to move higher. This is a live chart that shows today's action. So the group is up another 1%. Notice it went up above 470, got to 472, and it's back to 469. Just beware that 470 has been in a pivot area or a turning point for this group for the last couple of years. This has been an area where we've had some difficulties. So yes, it's looking better. PPO, you can see, has been above that zero line, which is good. But if we fail to hold the neckline, the PPO turns negative. Don't forget that the relative weakness of this area could come back into play for commodity chemicals. So anyhow, let's go ahead and move on. I know, Erin, you've got upgrades and downgrades, and we certainly want to get on with Martin Pring's presentation. So why don't you take it away?
You betcha. Lots of them to report today. I'm only going to go over about 6 of them, though. All right, so the first one up, I think everybody is familiar with Facebook. Guggenheim upgraded Facebook from a neutral to a buy, and they have moved their target from $175 to $200. So they're looking for a move up here, maybe to challenge this top. I would be watching more so for this gap to be filled as far as a target is concerned. Really nice breakout here of this trading range that we have been in for Facebook since the beginning of February. So I think that is encouraging. And then notice that it's coming in on a PMO buy signal. So, Facebook has started to make that move to the upside, and it'll be interesting to see how far it can run. But I have to agree with this particular upgrade. Fifth Third Bank Corp was upgraded by Keith Bruyette from a market perform to an outperform. It has raised its target to $32. So they're looking for a move to pretty much close that gap. You can see back here. We're back into the trading range we were in. We had quite a breakdown here mid-March for Fifth Third. But now we're seeing a PMO buy signal getting ready to come in. You could kind of make a case for a flag maybe forming. But I think the main thing is looking toward that $28 area of resistance. I mean, it does line up quite a bit. You can see the importance of that particular support resistance line as we've gone across. So I'm watching that $28 level. We did get priced to trade above the 20-day EMA for 3 days so far. And now we're looking at the 5, getting ready to cross above that 20-day EMA. Looks like right now it has. And that's a decision point short-term trend model buy. All right, NIO, new stock here, started up in September. And this one was actually upgraded by 2 groups, B of A Merrill and Citigroup. Both of them moved it from a neutral to a buy. You know, the PMO is starting to say, yep, maybe we're getting ready to make that turn to the upside. But the fact we have really struggled with this resistance area, which you can see was previous support of a trading channel that really lasted between October and into February. So at this point, you need to watch for that breakout. I mean, it did get upgraded today, but I'm not seeing enough here to get to take that chance. I'd really need to see that breakout above 575. All right, let's move on to some downgrades. Eaton Corp. This one, an industrial, was downgraded today from a buy to a neutral, and $88 is where they have their price target. But apparently they are looking for, well, it's in a neutral position as far as what they've now moved it to. So in neutral, you can still see a rise. Makes sense that it would be as far as an upper target. That makes sense when you look at the tops we had back here in September and October. Right now, we've gotten that breakout above this area, I would say, of what was resistance. And this really short-term resistance has been beaten out. But as you can see, still testing the waters before really making that move and trading above that top, that short-term top from mid-March. But I think it's encouraging. Look at the OBV is starting to make a move. So it's looking pretty good right now, even on a downgrade. All right, Live Nation was downgraded from outperform to inline by Evercore. Again, moving to a neutral position, not a sell position here. We did get the move down today to test that 20-day EMA. And, you know, the PMO had already come in with a sell signal despite price moving, you know, mostly sideways and then really trying to make its way back up. Look at this short-term rally here. And what happened with the PMO? Pretty much nothing. So that would have given me a little bit of concern if I were looking at this. And, you know, at this point, we do have support in the short term, right, at about 62. Well, it looks like 61.75, somewhere in there. We do have some support. But if we close down below that 20-day EMA, you know, it's managed to stay above it since the beginning of February. I think that would be a warning sign. And, you know, we're already down 3% today, and it was downgraded. So next and last downgrade I'm going to cover, Micron. You know, semiconductors have been doing fairly well. Micron's been struggling a bit in comparison. And what you can see here, Morgan Stanley downgraded it from equal weight to underweight. So this is actually moving into a sell signal sort of position here. And they've moved their target down to $32. Now, I'm not giving up on this one. I wouldn't give up on Micron at this point. We've got an ascending triangle, and that's a bullish formation. Granted, it tipped up there above it and couldn't stay. But, you know, maybe it needs to come down and test this rising bottoms trend line once again. The PMO has been rather flat during the formation of this triangle. And it is on a buy signal. And although it's decelerating on today's 3 1/3% drop, it's still above its signal line, and it still is technically rising. So I wouldn't give up on Micron just yet. If we end up with a drop and close below the 20-day EMA or below this rising bottoms trend line to form the bottom of this particular formation, that would be probably when I'd sell part of my position if I've been in it, especially in the short term. But I think that semiconductors are still looking pretty good, and Micron can probably continue to ride up on that. So I don't think Micron looks as bad as what they're saying. So All right, that's it for the upgrades and downgrades. Here are the ones that I did go over and the list of the ones I did not. This will be up in the Market Watchers Live recap at the end of the day. Just a few that you might find of interest, of course, is, let's see, Rio Tinto actually looked pretty good. It's been upgraded. Roku, Pump, Key Bank, Zions, all of those were downgraded today. That's it for the upgrades and downgrades. Be right back.
Well, this truly is a very special week here at StockCharts.com. As you know, if you've been listening in this week, we had Arthur Hill on Monday. Greg Morris came in on Tuesday, explained a little bit about Murphy Morris, how they got involved with stock charts. Carl Swinland was here talking about Decision Point also on Tuesday. And then yesterday we had a visit from Gaddis Rose. So literally we've been bringing in our titans here at Stock Charts. And today and tomorrow, no different whatsoever. We have Martin Pring live with us now, and tomorrow John Murphy will be joining us live. But Martin, the last few days we've gotten some indications from each of our guests as to how they got involved with stock charts, and I'm sure a lot of our viewers would like to know, how'd you get involved?
Well, it was basically through Greg Snell. I was talking at a CSTA conference in Calgary, and we were driving along one day where he was taking me to his house where I was staying with him, and he mentioned he was contributing to stock charts, and I thought, well, that's interesting. And over the next few months, we started talking about that, and eventually Greg suggested to Chip that we might benefit us both to get together. And so I met Chip at an IFTA conference where I was speaking in San Francisco, and that's how basically we got together.
So I know you and I were talking a little bit earlier. And one of the stumbling blocks, I guess, you had when you came on with stock charts was that your indicators, you had your own special set of indicators. That created a little bit of a problem, I guess, maybe at the very beginning.
Yeah, well, I had a weekly market letter I put out, and Chip suggested that maybe I might be interested in putting it on stock charts and running for stock charts. And I said, well, that would be great, Chip. But I've got these indicators that I use. And it would be really helpful if we could get those on stock charts. And so Chip said, no problem at all, had them up right away. And I thought today might be a good time to talk about some of these indicators. We won't have time to talk about all of them, but we certainly have to, we can look at a few of them.
Yeah, absolutely. I will say, I think Chip made a really good decision bringing in your Pring indicators.
Thank you.
All right, go ahead. Take it away, Martin.
Okay. We just get organized here with the screen.
No problem.
Right. You let me know when it's coming up.
I will.
Yeah, right now.
Yes, you got it.
Okay. But the first thing I wanted to go through was there are a number of these indicators, and they all begin with the symbol exclamation mark PR. So you can find out where these indicators are by putting up exclamation mark PR in the search button beginning, and you can see that they're all listed. So if you want to see a complete list, you move down from more results to PR. And they come up along with some other stuff like the prime rate, but basically they're the Pring indicators. And what I found out this morning when I was going through this was this mentions column over here. Because I thought, well, I'm going to spend a lot of time explaining how these indicators work today. But when I got onto this, I found out that the mentions also give you an explanation of the indicators. You click on that, and up comes an explanation of the Pring inflation indicator, which is what I'm going to be talking about first of all. And it's opposite the Pring deflation indicator. It also tells you how frequently it's updated, EOD, and then which public chart lists that mention this particular indicator. And if you've got a chart list, it tells you all the chart lists on which the indicator appears and all the commentaries on which it appears as well. So I thought that was a very useful piece of information to have. So let's go back now to the presentation. and look at our first indicator, which is the Pring inflation index, I should say. And what this is a group of 4 different sectors or industry groups, S&P industry groups, and I combine them all into one indicator. And all the 4 sectors are inflation-sensitive sectors, things like oils and mines and gold mines and so forth. And while they all move in a similar direction, it's nice to get them in an index format so that you get in case one of them is not performing up to scratch in a particular cycle, you can get an overall feeling about what the stock market's saying about inflation, whether it's betting on inflation-sensitive stocks or against them. And one of the things you can then do is compare the inflation index to the CRB composite commodity index, because that's really what they're dealing in. All these individual stocks are dealing in commodities. So when commodities go up, these stocks should be profiting from that. So one of the ways in which I use this indicator is obviously a very long-term thing. This is the monthly chart going back to 1995. But even if you're a shorter-term trader with a 2 to 6 week time horizon, it's always important to have an understanding of the direction of the main trend, whether it's going up or down. So that's why I look at these long-term charts to try and give me an overall long-term view about whether commodities are going up and going down. And obviously, I look at the CRB composite, but I look at what the stock market's saying as well, because I want to get both the stock market agreeing with what's happening with the commodity markets. So as you can see here, what I've done is one of the ways in which you can do this is to occasionally draw trend lines on both series. And when the trend lines are violated, that reinforces or increases the probability that the trend is reversed to the upside in this case, or the downside in this case. And that's all we're dealing with in technical analysis, is in dealing in probabilities. So the more evidence we can get in favor of a particular trend change, the stronger that signal is likely to be. One of the other things is, you notice I put some moving averages through this. It's a 12-month moving average, which I use most of the time for long-term charts. But you can see one of the problems with using the moving average is you do tend to get a lot of whipsaw signals in these jagged indicators, especially inflation-deflation ratio. So that's why I like to look at the trend lines whenever I can. And you can see we've got, what, 1, 2, 3, 4, 3 or 4 sets of trend lines. And when they're violated, give you a good, powerful signal of a change in a reversal in trend. That doesn't always work out. And it's another point I want to make. These indicators I find that I'm going through today are very useful, but they're far from perfect. But they do add an additional dimension to the analysis. So you can see here, we saw an upside breakout in the CRB composite, an upside breakout in the inflation index. That should have signaled by rights a tremendously strong rally in commodity prices, but it didn't. So one has to be prepared for the fact that sometimes this analysis doesn't work, and come up with a game plan for reversing or unwinding those positions when it doesn't go as expected. In this case here, we were able to look at a couple of downtrend lines that were violated. These happen to be head and shoulders necklines, of course, because there's the shoulder, there's the head, there's the right shoulder, and the same thing over here. So fast forward to the current situation, you can see it's really interesting because the inflation and deflationary forces have really been in a trading range for the last, 3 years. And the direction they're going to break out, it's going to have a very important, it's going to be very important implications for inflation or deflation sensitive stocks. Inflation in this case being things like oils and golds and mines and so on and so forth. So right now we got a sideways trading range with a slight downward bias because we're below the 12-month moving average on both these series. And we're also below this, or right at this trend line on the CRB composite. So this is it's actually at a pretty critical position here. So that's the inflation index. And then we got the opposite, which is the deflation index, which is an index comprising stocks that do well at the beginning stage of the cycle during a recession. Things like consumer staples, REITs, property and casualty companies, and things of that nature that are very defensive, and that a lot of them are interest sensitive. So when we look at the deflation sensitive, we find that gives you, when you compare it to the S&P, that in the long-term sense gives you some advance warning of weakness in the stock market. So for example, we have a peak in the deflation index up here and a peak in the S&P up there. So this is a chart that goes back to 1990. So a little bit of space means a lot. And so in other words, this was peaking, the S&P peaked in the beginning of 1994, and yet the deflation index peaked about 9 months earlier. And we see the same thing over here in 1998, that the deflation index peaked, but stocks didn't peak until 2000. And by the same token, at the market bottom, we see in 2003, 2002, October 2002, the S&P bottoms out, but the deflation index had bottomed out sometime before. So you can use the deflation index against the S&P to kind of identify when we're getting some weakness in the deflation index. It could well lead to weakness in the S&P. But by the same token, when you're at the bottom, a positive divergence is offering you some good vibes that the bear market in the S&P might be terminating. So in other words, we look at 2016, and you can see that it's moving in a sideways range here on the S&P, but the deflation index was making a series of rising peaks and troughs. So it was, and it never broke below its 12-month moving average, which again was a positive sign. Fast forward to the present, you can see the S&P's been in a kind of a widening trading range here since January 2018. So was the deflation index, but in the last couple of months, it's gone on to make a new high, a new all-time high, and it's suggesting that the S&P is like to make a new high as well down the road. So another thing we can do is compare the inflation index, the exclamation mark PRI, with the exclamation mark PRDI. And that is really the stock market's way of betting on whether we're going to have inflation or deflation, whether commodities are going to do well, or at the other end of the scale, whether bonds are going to do well. And whereas with the inflation index compared to the CRB composite, we don't get too much in the way of lead times. When we create a ratio of the two, then that ratio tends to peak out ahead of the CRB composite. As you can see, all these, and it also troughs ahead of the CRB composite. So you can see that in all these situations, these arrows are kind of pointing to the right. The sharper the angle they're pointing to, or the blunter the angle they're pointing to the right, obviously the longer the lead time. You see all the way through, you can get some idea. If you can figure out that the inflation-deflation ratio has peaked or troughed, then the chances are that the CRB composite is going to follow suit sooner or later. So how do you know when the inflation-deflation ratio is peaked or troughed? Well, one of the ways in which we can do this, and again, we're looking at it from a long-term perspective, is to take an 18-month rate of change of the ratio. When the 18-month rate of the ratio reaches the plus 50% mark and starts to reverse, that's when we get one of these red arrows. And you can see that pretty well all the red arrows, the solid red arrows, line up with peaks or in the ratio. There was one example where it didn't work out in 2010, 2011, where we got up to the 18-month rate of change to the plus 50% level, broke down back below it, and instead of reversing to the downside, the ratio moved to the upside. That's going to happen in life, but on balance, we've got, how many? We've got 1, 2, 3, 4, 5, 6, 7, 8 signals here. 4 of them bullish, 4 of them bearish, and only one real failure. So when you look at the situation right now is one in which we haven't really been doing anything for the last year, and that's also reflected in the price, that the momentum has gone in a quiet trading band, and so is the ratio itself. But when the ratio breaks out one way or the other, I think that's going to be pretty significant. To me, it looks as if it's in the process of forming a kind of a double bottom, because here's one bottom and then there's another bottom here. But until it breaks above this trend line, we won't know that this is a double bottom. And of course, if it breaks below this low here at 2016, that wouldn't be too good from the point of view of inflation, but the point of view of deflation, it would be. So that's another point about following this ratio. If the ratio is in a rising trend, you want to be emphasizing inflation-sensitive stocks. If it's in a falling trend, you want to be emphasizing the deflation-sensitive stocks, the consumer staples and so forth, REITs and so forth. All the ones that tend to do well at the beginning stage of the cycle and when inflationary pressures are not very high. So that's one way in which we can look at the inflation-deflation ratio. Another thing is to just draw a trend line on the rate of change. And in this case here, we drew a trend line between 1995 and 1999, and it broke to the upside and was followed by a nice rally. And we see the same thing down here in 2016. So one of the things, this is an 18-month rate of change. So one of the things we can look at is if it's ever possible to identify really long-term trend lines. The longer the trend line, the more significant the breakout and the price move is going to be after that trend line has been violated. So you can see that we're setting up for a peak here in 2008, and that's 11 years ago. So we've got an 11 years trend line here, which is still in force, of course, until the rate of change breaks above. But if it ever breaks above that trend line, which it will one day, that will signify a very strong rally in the inflation-deflation ratio, which would be a very powerful signal to move towards inflationary stocks and away from deflationary stocks, where the indication is that we should be right now, obviously, in deflation. So if this line gets violated and this one also gets violated on the upside, that will be the signal to move into inflation-sensitive stocks relative to deflation.
Hey, Martin.
Yeah.
Question. A lot of times when I'm looking at the commodities, the CRB and so forth, I also take a look at the dollar and how the dollar's been performing, because as the dollar rises, the tendency is for many of the commodity related areas to underperform the benchmark S&P. And when the dollar is falling, that's when we normally see the outperformance. So it kind of follows a little bit with your inflation deflation look. And so my question is, do you follow the dollar at all?
Oh, yeah. And I've got a special indicator on that, which I hope to show you in about 10 minutes.
Okay. I'm sorry. I jumped ahead.
No, not at all. That was a very good question, because most of the time you're absolutely right. When the dollar is moving up, commodity prices are pressured. When the dollar is moving down, it's bullish for commodity prices. There are exceptions where the commodities and the dollar can go up simultaneously, but they tend to be the exception. So you're absolutely right, Tom.
Okay. Thank you.
So I was talking about this very long-term trend line in the rate of change. And I just want to show you a couple of other examples of long-term trend lines that you can draw on the rate of change, on 18-month rate of change. This is because a couple of them are really interesting positions right now. This is the Shanghai Composite. And it's a monthly chart. And this trend line begins in 1997 and goes all the way through to 2006. And you can see what happened when that long-term trend line on the 18-month rate of change got violated. And it was also confirmed by a shorter trend line break in the price itself. The thing exploded. So the reason I'm showing you this chart is because the Shanghai Composite, as we speak, is right at this downtrend line just here. And it's already started to edge through this trend line, joining the 2015 top with the 2018 top. So we could be on the verge of a very important bullish setup here. And another reason why I'm quite excited about Shanghai is the fact that this is a secular uptrend line, goes back to 1996. Long trends give you very powerful signals when they're broken, trend lines. And this one was broken on the downside, indicating that probably Shanghai was going lower. But what happened was it reversed itself, and we're now back above the trend line again. So in other words, all the guys who bought in this period here and went short, I should say, are coming home with a loss. So they're forced to cover. And usually when you get a false move to the downside and it's confirmed by a new trend to the upside, which it is with this breakout here, you get a very powerful move. We've also seen that we've got this long-term trend line down here. So if it gets a little bit more strength, it's going to break that, bust that trend line, and we're going to get a very, very powerful move. Even though we had a pretty strong rally already, on a long-term basis, because this is what we're talking, Chinese markets like to move much higher. Another example of this rate of change comes from the gold price. And you can see that it broke this downtrend line going back to 1988 to 2002. We see a similar break in the price from a longer term trend line. And look at the huge move that followed that. And also there was a small base that formed. Fast forward to the current point, and you can see that we've got a trend line going back to 2011. Not as long as this trend line here, but certainly a pretty long trend line of 8 years. And it's still in force because we haven't broken above it. But you can see if the gold price ever breaks above this resistance trend line here, and I think it's around 13.25 or something on a month-end basis, that would confirm this trend line break and offer a very strong rally in the price of gold. Again, gold and the dollar tend to move inversely, so we're in the same dilemma you were talking about before, Tom. So getting back to the inflation-deflation ratio, the last chart that I show you on this, I wanted to point out that it's at a very, we saw that it was in a trading range on the monthly chart. This is a daily chart. You can see how it's now falling between these two converging trend lines here. And since when's this, last August or something, it's really not moved anywhere at all. So it's at a very, very critical level here. Breaks to the downside, we're going to see further deflationary effects. If it breaks to the upside, then of course that would favor inflation-sensitive stocks. So that's something to bear in mind. So I want to show you another indicator now. This is this one measures the bond market, and this one is the bond net new high indicator. What it does, it takes a universe of exchange traded funds and yields, prices and yields of various sectors, and figures out the percentage that's above its 40-day moving average and a percentage that's below its 40-day moving average, and takes a net result. So that when it's down here, it means that basically most bonds are trading below their levels 40 days ago, and when it's up here, most of them are trading above their level 40 days ago. So the idea here is that when it moves to an oversold condition, which I put at minus 1.5, and starts to rally, that's when it gives us a buy signal. And as you can see, all these buy signals, because we're basically in a secular uptrend for bond prices, all these signals were pro-trend signals, so they tended to be on balance accurate, until we come to October back here last year, and you can see that the indicator bottomed and reversed from this oversold level at minus 1.5, and then subsequently broke above this neckline of this reverse upward sloping. Well, it's not really an inverse head and shoulders because this low is about the same level as that. But the point is, there was a battle between buyers and sellers going on, and it was the buyers that won the battle, and that was all we needed to know. Now we're looking at the same indicator, but now we're looking at the peaks. And because it's a secular rally, it's a long-term rally here that's taking place in the price, when we get short-term signals that would normally generate some kind of a severe correction, like they did here and like it did there when it peaked from above this extreme level at 345. When you're going on a contra-trend basis, that's the time when, if you're going to have a failure, that's the time when it usually happens. So in other words, this is a bull market we're seeing here, and these sell signals were short-term sell signals under the context of a bull market. And when that happens, that's the time when you tend to get your failures. So right now, it's at a very interesting point because it's at a record high. And that suggests to me that obviously it's still in a bull market as measured by the 200-day moving average, because it's still above the 200-day moving average. Long-term momentum is positive, and other long-term moving average positions are positive, like 12 months. So it's still in a bull market. So on the one hand, you can say that this is overbought, and we should expect to see a correction. But on the other hand, it's a signal of a correction within a bull market, so it doesn't have as much power. So basically, it's more of a signal for traders than it is for investors, because investors don't want to get out of this until we see some kind of long-term signal on the sell side. But as a trader, you don't know whether or not it's going to have some kind of moderate effect. So you probably want to be lightening up on bonds here, especially as I'm reading reports that in the first quarter or so, the public was rushing into the bond market and rushing out of stocks. But the public is usually wrong in these decisions. So that's something to bear in mind as well. So finally, on this chart of net new high indicators, I'll show you can use it for overbought and oversold reversals. You can also use it for divergence analysis. In other words, when the 7 to 10 year bond ETF, the IEF, makes a higher high here, and the indicator itself doesn't, that's a sign of weakness. And when it gets confirmed by some kind of, you need some kind of a indication that the price is agreeing with that, and that would occur with a trend line break just here. And then we go over here, for example, where you get the opposite situation, where the price of the bond makes a new low, but the indicator has started to reverse, and it started to reverse from an oversold level. So you got a couple of pieces of information that the bond market was likely to reverse. It doesn't tell you how strong the move is or what its duration is going to be, just merely that you have been used to the price coming down, and now it's probably going to get into a situation where it's going to move up because there's positive divergence. So if we look back at the October, summer to October period last year, you can see that the price of the bond went sideways, and the indicator made a higher low in October than it did back in April. And you also got a subsequent confirmation from the price in two ways. One, it broke above this trend line we saw in the previous chart, or the first chart on this indicator, and the other, it broke above this much longer downtrend line. So that's the second indicator, the bond net new high indicator. Now we have to move to next panel. And this one's going to be of interest to you, Tom, because it's got the US dollar, and underneath is my dollar diffusion indicator. And this one measures, looks at a universe of cross-dollar relationships. Because remember, when looking at the dollar index, it's got a 57% weighting to the euro. That's a very high weighting in one particular currency. So we want to get a broader view of what's going on with the dollar. So we look at this dollar diffusion indicator, which measures the percentage of this universe of cross-dollar relationships that are above or below their 40-day moving average. And so when most of them are below the average and starts to turn up, that's when we get a green arrow here, which indicates a buy signal, obviously, that the diffusion indicator was oversold, now starting to reverse to the upside. So that's a positive thing. And you can see in pretty well all these situations, you get some kind of rally. It doesn't tell you whether you're going to get something like this or just a more muted rally like that. But if it was coming down, it's certainly indicative of the fact it's unlikely to keep going down anymore when the indicator goes positive. So right now you can see that the indicator is in a bullish mode. It's not, we don't know how long it's going to stay in a bullish mode, but if it was up here at the 10 or 12 area, then we could be preparing ourselves for a potential reversal. But it's kind of a neutralish sort of reading just here. And that suggests that it's got more upside potential before it gets overbought. And then the dollar itself is above this support trend line here and its 200-day moving average. So that represents a very, very significant level of support, because it's the moving average represents support in its own right. And then you add to that this trend line, which also has a dynamic level of support. You add them together and you've got a very significant level of support. If that gets violated, that would not be good for the dollar because of that violation of that strong support. On the other hand, we got some resistance up here around 98. If the dollar index can rally above 98, that will cause a breakout to take place and will be very positive. So right now, the indicator itself is in a rising mode, and that suggests to me that we're going to see an upside breakout in the dollar. Certainly, when you look at the long-term measures of the dollar, like dollar relative to 12-month moving average, or long-term smooth momentum like the stochastic or the MACD, all that stuff is, depending on the time parameters you have, but the ones I use, the KST, for example, are all positive at this point. One other point I'm expecting an upside breakout in the dollar. One other point I wanted to make on this was that I've got this pink shaded area here, and that's indicating a primary bear market, because you've got at least a 1 year major decline taking place. So remember I was saying about contra-trend signals not working? Well, here's a great example here. We get a buy signal, which would normally get a solid green arrow. This one gets a dashed green arrow because it's a failure. because it occurred, it was a contra-trend signal. It was a buy signal in an ongoing downtrend. And always remember that the trend, the prevailing trend, the primary trend, is always going to dominate what the characteristics of what happens on a short-term trend. So in this case here, we had a short-term buy, and the characteristic was it was a failed signal or a very weak rally. Here again, we're still in a bear market. We get a stronger rally, so I've given it a solid green arrow, but it really is not a great rally and probably should have a dashed arrow there. So bear that in mind. Now, another way in which you can use the dollar diffusion index on certain technical events is over here, where we've got, once again, we got the dollar index. Actually, it's the bullish dollar ETF, the UUP, and a currency diffusion indicator, the same one we're looking at before. And one of the things I was mentioning before was when you get a whipsaw, you often get an above average move in the opposite direction of the whipsaw. So in this chart here, we've got 3 whipsaws: a break to the downside, a false break to the upside, and another false break to the downside. Well, if you get something like that, one of the things you want to make sure is you get a confirmation of the whipsaw. So in other words, here's the whipsaw, it breaks to the downside, then it breaks back again. How do you know that it's not still a valid break to the downside? Well, you wait for some kind of a trend confirmation from the price, in this case, a break above this trend line, or in this case here, a break above that trend line, or in this case here, a break below that trend line. But you can also introduce the currency diffusion indicator, because if it's likely to be a false breakout on the downside, you'd expect the market to be oversold, which it is. And number 2, a breakout to the upside, if it's going to be false, you'd expect to see the oscillator overbought as well, which it is. And the same thing down here, another false breakout, and we saw the market was oversold. So when it's oversold, it's unlikely to go much lower, and therefore that breakout stands a chance of being false. I've got a couple of minutes where I can just show you another indicator, the last one I'm going to talk about today. This is what I call my bottom fisher, and it tries to identify bottoms in the stock market. So here's how it's constructed. This is a theoretical momentum indicator, a short-term KST, and I divide the momentum indicator into 4 different quadrants. Winter, when it's below 0 and falling, which is as bad as things could get, what you might call the markdown phase. Then the beginning of the next bull move is in the spring quadrant, and then the market phase, which is I call summer, and then finally the distribution phase, which I call fall. So what I'm trying to do with this indicator is when you take a universe of stocks, in this case we're going to take the Dow stocks, and a majority of them is in this position here. The next place they can go is over here into spring. So the idea is that when the indicator shows a large number of stocks in this position here, and that starts to reverse, that typically is associated with a bottom in the stock market, and a small bottom. So this is what this indicator here, this is the B fish here. And because it moves inversely to stock prices, what I've done is I plotted this inversely, or the indicator is calculated inversely. So when a high number of stocks is in that winter position, you actually get a low reading in the indicator. So once again, when we go to it doesn't call tops, it just calls bottoms. So every time it comes down and it crosses its moving average from below the low level here, that's when you get a buy signal. It's not perfect by any means, as you can see from here and here. We had some failed signals, and we had a couple more here. I mean, it went up, and it's supposed to give you a buy signal for like 2 to 4 weeks, and I guess that succeeded. But it was nothing like this buy signal over here. So it's not a perfect indicator, but it does have a pretty good track record of identifying short-term lows when they materialize. So I think I'm going to stop there, Tom. And if you have any other questions, we could lead into them. Or
yeah, there were a couple questions in the room. First of all, great presentation. I think everybody is just kind of staring with mouth wide open at some of these indicators that you developed over the years. They're really fascinating. So great job there, and great job explaining it as well. But a couple questions. One, do you have any thoughts on the weakness in small cap stocks?
I don't follow that very closely, so I'm gonna pass on that.
Okay, fair enough. Another comment. Someone indicated you're the only analyst they know who actually tried to make indicators such as these Do you have any suggestion on a possible ratio that would indicate stagflation?
Stagflation.
Yeah. I guess. Well, go ahead.
That's when the economy weakens and you have a lot of inflation.
Yes. Have you done any?
No, when you have a lot of inflation. No.
That was easy. That was easy.
And the reason is I've never thought about designing an indicator for stagflation. I'm more interested in whether commodities are going up or not, or bonds are going up.
Okay. Well, I mean, anytime you get high inflation with high unemployment and so forth, that's, kind of that I guess is where the question is going. Certainly, I would say based on what we're seeing in the market right now, we'd have nothing like that.
No, it's the opposite. It's the opposite.
Exactly. Let's see. There was one final question. I mean, given where the market is, we've had a huge rally off the December low. Is there anything in particular that you really like from a trading or investing standpoint?
Any specific area?
Yeah. Any thoughts on where, somebody who's listening, where you might want to look as, based on what you're seeing in the market right now?
Well, if you can think of a long-term momentum indicator, let me just go back to, let's say this is not the short-term KST. Let's say it's a long-term KST. Obviously, you want to be buying groups or stocks that are here rather than over here, right? Would you agree with that?
I agree. So
the ones that are in this position here are things like utilities, REITs, gold shares, which can be a defensive play. Whereas over here, we've got quite a few stocks like the S&P itself. That doesn't mean to say that it can't suddenly start to turn up and then move immediately to summer. But when we get a bear market low, typically what you'll see is everything is concentrated in this area here that I'm circling. So what I would like to see, and the market certainly doesn't oblige me in any way at any time, is for a lot of the groups that are up here, like the S&P, to undergo a correction so they could come down more into this area here from where they could reverse to the upside and get more of a sustainable rally. But right now, as I see it, it's more the deflation-sensitive stocks which are doing better. As I say, the REITs, the consumer staples, that kind of thing. That kind of thing.
Awesome. Well, I do have to say this was a great presentation. Really appreciate you coming on and joining us this week. It's a special week here at StockCharts, and we certainly wouldn't want to do this week without you. Great work as always. And I do want to mention to everybody that you do have a show that's on Saturdays, the first Saturday of the month, 2 o'clock Eastern. So if you enjoyed Martin's presentation here, I would certainly encourage you to check that show out. First Saturday every month, 2 p.m. And Martin, it was a pleasure once again, my friend.
Okay, thank you, Tom.
And there he goes. Another great presentation. Okay, we're going to move on here. I want to introduce a new segment that's going to be a part of Market Watchers live shows in the future. It's called Talking Technically, and it will feature various commentators here at StockCharts illustrating different technical analysis concepts, all as part of a new learning series. So we are debuting it today. So listen in as Greg Schnell discusses the volume by price overlay.
I'm going to talk about how to use the volume by price option on StockCharts. It's an overlay, not an indicator. And what we do is we put it right in the back behind the price. So in order to do that, we're going to go in under the overlay section. We're going to select volume by price, and it defaults to 10 bars. But if you'd like a little finer control of that, you can set the number of bars there by just putting in a number, and usually an odd number is better. But what happens is when you select that, it will draw out the bars, and you can see that clearly this current bar is one of the highest levels of resistance or support. So this is a very interesting place for the price. Anyway, so remember, when you're using volume by price, it's an overlay, and you can select how many different bars you want to see on the left-hand side, all the way up to 100.
We hope you enjoyed Greg's discussion about volume by price. It can be a very useful addition to identify high volume price ranges that highlight support or resistance. Also, I want to mention Talking Technically is a new feature, new segment that is going to be aired every Thursday. So make sure you tune in and check it out. I think it'll be another great addition to Market Watchers Live. Okay, Erin, let's get into the 10 in 10. I'll let you take it away and we'll take a quick look at the RRG.
All right, here we go. Not too many requests today. I always know we have a great speaker when that happens because everybody is paying close attention. Healthcare and technology seem to be the winners today as far as requests. So go ahead and like the symbol requests that are in there. The most popular will be our next one, but we're going to start with Marriott.
Okay, let's pull up Marriott and get into this. Yeah, I mean, the breakout here recently was very, very nice. I haven't annotated this one yet, but you can follow along here. I do like the fact what I'm seeing here is a character change. This is a stock that had been downtrending. I think when we got back up above the 20-day, you can see we came back down, tested this area of price support. It was prior price resistance. So I would first annotate that level. It looks like we went just a little bit below it, but not much. Came right back up above it, held that 20-day, and now you can see we've broken out again above that prior high. So I like what's going on here. The only thing I would say is that while it's been a pretty good performer relative to the overall index, the hotels are getting close to a key area of resistance. So maybe also consider putting in an annotation there. And I'm going to go up just a little bit higher so we can catch this high. So I think we got to get a breakout above 0.70, showing that the hotel index relative to the S&P is breaking out. And then I think that adds to the strengthening technicals here on Marriott.
All righty, let's see. The most popular in the chat room is FXI, the China large cap ETF.
Yeah, I definitely think we're seeing a pretty nice breakout here. Actually, don't need to put it on the relative chart. But here, I'm just going to annotate what to me appears to be a really nice ascending triangle. So if I go in and highlight these highs coming across here, you can see that. And then the lows rising. So I think off of the uptrend that we saw to begin 2019, I think we've been consolidating for about 6 weeks, just now making a breakout. I think this looks pretty good. I think the FXI, I think we've seen the worst in terms of what's been going on over in China. I expect we're going to see higher prices.
All righty. Let's see. Next one up is going to be OKTA.
All right. This is in the software space. OKTA Inc. Okta Inc. We did get a breakout. We're pulling back today. The NASDAQ's having a little bit of a rough day today. And I think that's partly why we're seeing such weakness. We did make a breakout. If we fail to hold it into the close, I do think that could open up the door, perhaps to a little bit more short-term selling. I like this stock, though. Here was that breakout I was referring to. So there's your breakout yesterday. Nice volume, but all of a sudden, we're not holding it. Now, if we can rally off this low and move back up above, say, 87.5, 88 later today, I think that would be incredibly bullish, given the breakout yesterday, the false breakdown today, and then coming back up. But let's see whether or not we can hold that. If we fail, then I think it brings in potentially maybe 75 into play. And I know that's 10% lower than current price, but these stocks are extremely volatile. Some of these software stocks that have been big performers. So anytime you get into volatile stocks, you have to be ready for some volatility. So those are the key levels I'd watch here.
All right, let's see. The next one I'm going to give you from the software space, Workday, WDay.
Yeah, this is one actually I liked quite a bit. Well, we did go back up and hit that recent high or got close to it. Now we're back down near the low again. This is one that on this pullback, as long as it holds the lows, and I would be watching maybe a couple of areas. There's your gap support. So we had the gap up in January. That was earnings related. We have not yet gone back down to test that. Here was the prior high back in January before that earnings gap. And you can see we did test that, and we're getting close to it again. I think 173 to 176 is going to be a key pivot area. It could be a turning point if we get down to that level. But again, very much like the last stock I just looked at, OKTA, a lot of volatility because these stocks have moved so far so fast. This was under $120 back in November and just hit 200 to start March. So anytime you get into a stock like this, you have to be prepared for some volatility. Clearly today, not a good day, but I would look for a reversal in that 173 to 176 area.
All righty. This one has been asked for almost every day, but we look at it often, but we haven't looked at it in quite a while. How about Tandem Diabetes, TNDM?
Yeah, this one I actually bought. So I own it right now. I liked it when it held. It actually went a little bit below the prior low. And when it came back up above it, I bought it. And I'm going to put this on a relative chart. I'm going to keep a tight stop, though, I can tell you. Just because the market's come up so much, if it does fail, I want to make sure I get out without too much damage. But I've said before, I like it around that $60 level. You can see the medical equipment group is broken out. Tandem's been a great performer relative to the group, relative to the S&P, and the group has been very strong. Although you can see so far in April, on a relative basis, we've seen some weakening here. But I think it's relative profit taking after a big move to the upside. We've seen this before if you go back. So I think this is setting up for another move to the upside. And as long as Tandem can hold this $60 level or say 59.5, I'm going to be okay. If we fail, that's when I'd grow much more concerned. So there's your support. That's what I would watch.
All righty. Our only consumer discretionary match group, MTCH.
All right, match. Yeah, I'm seeing a little bit maybe of an ascending triangle or maybe just a flag. Pretty good action overall in match versus its peers in S&P, but the overall group has not been great. So if we get back up above, say, that relative high on March 8th, that would be a possibility of further upside. But let's go ahead and annotate the levels. I would be really careful. I'm going to put in this gap down low here around 52, maybe just below $52. I think you've got some resistance coming up near 60. So I think we're just in this trading range, and this movement back and forth for me is just a lot of noise. But off of an uptrend, sideways consolidation normally gets resolved to the upside. So I'd be looking for a breakout before a breakdown.
All right, excellent. Next one up is SPWR, SunPower.
All right, SPWR. Yeah, I like the breakout here, short-term breakout. Obviously, we've got some other areas that we've got to, take out as well. When you look at on a relative basis, the renewable energy space has been slowly working its way higher versus the S&P. You can see that SunPower is broken out to a 2019 relative high, and it's also broken out versus its peers. So there's a lot of good going on. I would maybe, well, I don't know if I want to give this much room. I was thinking maybe down to the double bottom, but that would be a lot of room if I was just getting in or if I recently got in. But that is a level definitely to watch, $6. Maybe to keep a stop a little tighter. If we truly are uptrending, then I would be looking for the rising 20-day moving average and maybe drawing that breakout level right there at about 675, that rising 20 days coming up from underneath. So maybe that would be the initial area of support to watch.
All righty. How about Walmart?
All right. Yeah, I recently traded Walmart, but I got out of it. Let's see what it's looking like here. Yeah, it's kind of just about where it was when I got out of it. It's a pretty good area of the market, but Walmart on a relative basis has not been a great area within that space. So I'm just seeing kind of sideways performance of its peer group relative to the S&P, and Walmart has not been one of the better stocks. I thought after we had this move up, we pulled back, that we would eventually get a push back to the upside. It really didn't last. I would watch closely these recent lows. So if I was in Walmart, I would be watching, probably have a fairly tight stop. And I'm talking about short-term trading, by the way. If you own Walmart long-term, it's a great company. I'd have to look at different indicators from a longer-term perspective. But short-term, I think if you go back the last 6-7 weeks, that 96.5 area has been pretty significant. So move much below that area, and I would be out.
All righty. I'm not thrilled with the name of the symbol, Globant, Glob.
Glob.
Yeah. It always sort of I don't know.
Yeah.
Generally, a glob of something isn't good.
Yeah, you could maybe diversify and have a little glob and a little splunk.
There you go.
That was a joke. No, don't go rushing out to buy these two stocks. Actually, this one looks pretty good. I mean, you're in the software space, which has been strong. Glob, relative to the software, was doing great until January. We've seen a little bit of downside action, but I would like to maybe take out this latest double top over the last 4 weeks on a relative basis. So we did break out yesterday, but like so many software stocks, we are pulling back today. I would maybe just watch the recent price lows down here around 67.5. I think also the 50-day moving average, which held, that's up near 70. I think as long as we hold that area, we're okay here.
All right, last one up, JP Morgan.
All right, last one. Big bank. All right, JP Morgan. Well, after it looked like a breakdown, now we're coming back up. I would just say, we are in a trading range, and I don't really have any strong buy opinions on the banks until we get that 10-year Treasury yield moving higher. I think that is still going to keep a lid on a relative basis on the banks. And what I'm talking about is down at the bottom here, this right here. I mean, if your mission is to outperform the S&P 500, it's hard to do it with banks, and it's been hard to do it with banks for the last year because the 10-year Treasury yield continues to drop. And as the yield curve narrows, that spread narrows, gets closer to zero or goes negative, depending on which yield curve you use, that's not good for banks. And so we're seeing a lot of underperformance there. I would personally avoid the group right now. I haven't traded a bank in a while since I let go of Bank of America a while back. And even within the group, if you look at JP Morgan relative to the banking group, we topped 3 or 4 months ago. And we have started to outperform over the last 5 weeks, but still a lot of work to do to get back to that prior relative high. So I just think it's a kind of a hold. I would not initiate positions, at least for me, I wouldn't.
All right. And that does complete the 10 and 10. I'll have these symbols and charts up in the Market Watchers Live chart list at the end of the show. We will be right back after this message.
Join us April 1st to April 5th to celebrate our 20th anniversary here at StockCharts.com with special guests Arthur Hill, Greg Morris, Gaddis Rose, Martin Pring, and John Murphy.
And it is time for our final market update. And Tom, the word you use often, the bifurcated market. As you can see, we have the Dow is up. It has pulled back about half of its gains, though, from this morning. And the S&P 500 has hit negative territory. But notice with the NASDAQ, we're really seeing technology hit pretty hard today, and it is continuing in its declining trend. We've got the mid caps on the positive side, and the Russell 2000 is on the positive side, just barely, but still there. Canadian markets are flirting with yesterday's close, hoping to get back above into positive territory. The Treasury yields are down slightly, currently reading 2.508%. The VIX is really mostly unchanged. We're at 1376, still in that complacent area, I would say, for investors. UUP, the dollar gapped up but is consolidating sideways, currently up 5 cents at 26.05. Gold is down slightly, but boy, did it take a hit early this morning with a gap down. And it's been making ground ever since then and might actually hit positive territory. USO is up slightly, reading $13.01. And TLT is continuing a consolidation that started yesterday. Let's look very quickly at which sectors are winners and which are losers right now. Financials and consumer discretionary are leading the way, with not far behind the industrial sector. Technology certainly getting hit the hardest, not a surprise to see this. given the decline going on in the NASDAQ right now. That's all I have for the final market update. Back to you, Tom.
Yeah, just a quick note on, and this is a ratio of the NASDAQ versus the S&P 500 going back the last 10 years since we bottomed back in the first quarter of 2009. And you can see that the overall trend here continues to be higher. Yes, it was scary in the fourth quarter, but we've seen that before. We saw it in 2016, saw it a couple of other times earlier in this uptrend. The key here, the key takeaway for me is that the PPO, the momentum of the NASDAQ versus the S&P has turned positive again. We're above that 20-week moving average. And when we're above that 20-week moving average and rising, it tends to be a very good sign for the overall market. So the S&P 500, we're not too far from an all-time high. And given what's been taking place in terms of the NASDAQ outperforming, probably not too far away from seeing an all-time high, in my opinion. Okay, we are going to move into our final segment, and it is Turning Point. And so this segment, if you're unfamiliar with it, is just us looking at different stocks, trying to identify possible areas of turning points. So it could be a breakout. It could be maybe a reversing candle. It could be a lot of things, PMO crossover for Erin or something like that. But Erin, I'm going to let you take it away. What turning point stocks do you have?
All righty. I did a couple of different scans, so I really don't feel like I need to share one because it was just sort of all over the place today. But I think I found a couple of really interesting ones. And the first one I want to look at is American Eagle Outfitters. And I've got the PMO buy signal that already came in, but I'm happy with that, especially when I look at a flag formation. And, you know, really, if you look in the thumbnail, it is pretty textbook. Coming in on this rally. And we're getting the breakout from that flag. We already had pierced and we're trading above that area that was resistance. And you can see it does line up quite a bit with some of the older bottoms and tops that we've seen that area. And so the fact we're above it, today we're trading completely above it. We're getting a breakout from that flag. And like I said, PMO is supporting this. Pretty decent scooter. You know, I wouldn't have minded a little bit better look on the volume, but the main thing is the 50-day EMA is just now crossing the 200-day EMA, and that moves American Eagle into a bull market configuration. So we can start expecting those bullish conclusions to bullish patterns. So at this point, I'm thinking American Eagle actually looks pretty good. It looks like it is changing its character. Aptiv. APTV, this was the other one I was looking at. PMO buy signal today, nice breakout. And really, I didn't draw, but a declining trend, a declining tops trend line, and we already had beaten that out yesterday. Actually, it looks like the day before. There's that 5,200-day EMA positive crossover. We're getting a breakout today, which I like very much from the short-term look. And really, when you're looking at upside potential, you know, the main area of overhead resistance is going to be all the way up here at about 97.50. Now, you could find a little bit of trouble here at these previous lows that we saw back in June and back in August, and that would put you right about 87.50. But given the really positive look of the PMO, and notice also OBV. And there you go, volume. Look at that volume coming in on this rally. I think this one looks pretty good, and I think we're ready to make another move, continue this one to the upside. CH Robinson was one that I was looking at. Again, a breakout from a declining tops trend line, a PMO buy signal. And what I was noticing also is a possible reverse head and shoulders here with a downsloping neckline. If we can get up there, and you can see that that's also a short-term area of overhead resistance at $92. So that's one I think that's looking good. And look at that volume coming in. Like it. A couple others, and then we'll pass it to Tom. Cowan and Company, double bottom formation coming off of a decline. That's pretty much textbook. It is struggling right now to get above the confirmation line, but given that nice looking PMO buy signal, you know, volume is a little so-so on the OBV, but certainly not negative. I like the chart pattern. I like the buy signal. Eastman Chemical. breakout from a declining trend. So this one has been really suffering, and now it's had that breakout from that declining tops trend channel there. We're also seeing a breakout on both the OBV and the scooter as far as the volume goes and its relative strength to its peers. And of course, a PMO buy signal. Gotta like that. And finally, Cayman Corp. It's been in a trading range pretty much. We've just hit what I would say could be some short-term overhead resistance, but I like the PMO buy signal that's coming in, and I would look for a breakout here. So those were the ones that I had, Tom. What are you looking at as far as turning point stocks?
Okay, well, first I want to just go back to the dashboard and just make sure everybody's aware under the member tools that you can get into the predefined scans. This is really the subject of our poll today, trying to highlight some of the areas you can go to on our site to be able to look for stocks that potentially could be turning point stocks. So the poll talked about a few different things, talked about 52-week highs. Obviously, if you've been consolidating for a while, the stock's been doing nothing. When you make a 52-week high, especially if it's been consolidating, that can be a turning point. We could go from a sideways consolidating stock to one that begins an uptrend. Strong volume gainers. I think that's also very good, especially if it coincides with maybe a bullish engulfing candle off of a downtrend or something like that, or news story that creates a gap up and you've got heavy volume. That could be a character changer on the chart. Mention the momentum crossovers. So it could be as simple as a 5,200-day moving average cross. That's a momentum indication. How about the bullish MACD? Erin just talked about her PMO and the crossover. So those are different momentum crossovers that certainly could signify a turning point. If you go down further, you can see the gaps on here. So if you're somebody who likes to trade gaps, well, there's already predefined scans in here to identify these for you. And if you go all the way back down, you can see candlestick patterns. I'm a huge candlestick fan, and you can see a number of different candle patterns that could produce turning points on some of these charts. So I just wanted to make you aware that these are there, and you should take a look at them from time to time. They're predefined. You don't have to go write your own scan. They're already here for you. But I looked at the 52-week highs and pulled up the New York Stock Exchange 89 stocks that were in here, and then went down the list to see if I could find some of these. And I wanted to just mention a couple of them. One is Max Linear. So again, these are 52-week highs. This is what I was talking about. You got an uptrend, and then for about 5 or 6 weeks, we've got sideways consolidation. Now, all of a sudden, we've made a breakout, and we begin what I believe could be another trend to the upside. So for me, I think MXL is one that, well, really technically would have been earlier this week, but it looks to me like a turning point here. Another one, let's go back and pull up Gildan. So Gildan, now this one had a breakout earlier today, but is currently trading below the breakout point. So this, if it holds, could be a turning point back to the downside, where we get a false breakout and come back down, close closer to the low of the day, and then maybe we go back and test support. So just because you get a 52-week high doesn't always mean that it's a turning point to the upside. If you have a false breakout with a 52-week high, it could be simply that we are ready to turn back to the downside. One other here is APH, Amphenol, another technology company. Now, I want to bring this one up a little. I'm going to go back a little further here, a couple years. I want you to take a look at this chart because not all breakouts are equal. Looking at that 6-month chart, you just saw it was a breakout above recent highs. But this is a stock that's been consolidating sideways for about 15 months before making a breakout. Now, we've gone up again. This one broke out earlier this week. Maybe we get a pullback, but $96, $97 on a pullback would be pretty nice on a stock that I think made a turning point by getting this breakout. Okay, back to the predefined scans. Strong volume. If we pull up the strong volume gainers, now some of these may have changed because I've gotten further into the day, but let's take a look at maybe some of these. ASYS. It's in the semiconductors. They are planning to divest their solar businesses and focus solely on their semiconductor business. This is news that came out today. Now, it normally is a light stock, light volume stock. Probably wouldn't get my interest, but obviously you can see the heavy volume and why it's on this list. So ASYS is one to think about. Another one is Tesco Technologies. I didn't see any news for this stock, but you can see the volume. And again, light volume stock, so I'd ignore it there. But last 2 days, very heavy volume, and a close above 17 would be its first one of 2019. So you get heavy volume and a breakout, that can be pretty powerful. And then the last one I have is DBVT. They announced a stock offering. And it's kind of unusual because a lot of times when a company comes out with a stock offering announcement, people think dilution and immediately the stock goes down. But when you're in a company like this, and I'm going to pull up their relative chart here, when you're in a company that's in the biotech space, one big problem sometimes can be not having enough cash. So when a company makes an announcement in biotechs, who cares about dilution? The company probably has no earnings anyway. So it's more about raising cash and having the cash available to fund some of their projects. So I think that's why we're seeing DBVT up. But again, you can see that volume picking up. And that is all we have today for Turning Point. So here are the stocks that we just covered. And I thought maybe what we could do is go right into that poll. I want to make sure, Erin, everybody's aware of predefined scans because you certainly can find Turning Point stocks by using some of those scans.
Absolutely. And I know I've stolen some of those, the scan code to put into my own scans just by looking at the predefined scans. So I think that it's definitely worthwhile. Now, yeah, looking at that poll, I'm not surprised to see the crossovers on the top. I put that in strong volume. I put that in. I'm not a candlestick girl, so I didn't put that. And I do look at those 52-week highs and lows. I don't really look for gaps on my turning points and, to find it. But once I see it on a chart that I pulled, important.
Yeah. Well, definitely a breakaway gap. I mean, if you got a stock that's been sideways consolidating or trending lower and all of a sudden you get this big gap up, that can be a major trend reversal.
Absolutely.
But I am surprised that 52-week highs and lows are at the bottom. That is one that I think is, I would have thought was a staple. That's one I look at very frequently among the predefined scan. So I'm kind of surprised that one was on the bottom. I would have thought maybe that would have been on the top. So I was way off on that poll.
You never know.
You don't. All right. Just quickly, you can see the NASDAQ has actually moved off of its, oops, didn't mean to do that, has moved off of its earlier low, but it does look like maybe it's rolling back over again. So we'll see how we finish. Remember, tomorrow morning, we got non-farm payrolls coming out. That's going to be a big economic report. ADP employment that we had yesterday morning was below expectations, although we did have a positive number. But if you recall, non-farm payrolls last month was horrendous. So I think a lot of folks will be tuning into that. Also want to mention that John Murphy will be with us live tomorrow. Really important announcement there. We have never had him on our show, Erin. He's never been.
He has never been live. No, so that'll be great to talk to him. I'm really looking forward to it.
Yep. So if you get one show that you come to, of course, you want to come every day. But if you had to pick one, tomorrow is going to be the day. Can't wait to have John come on. All right. Want to thank everybody for being with us today. Please remember to complete the survey as you exit. We really like to hear what you think of our anniversary week shows. I mean, I think they've been fantastic. I'd love to get your feedback, what you thought of Martin Pring's analysis today. I think it was exceptional. As a quick reminder, Market Watchers Live airs 5 days a week, Mondays through Fridays from noon to 1:30 p.m. Eastern Standard Time. Have a great Thursday afternoon, everybody. See you back here tomorrow. Happy trading.